And good morning, good afternoon, good evening, everybody. Welcome. It's very nice to see so many of you connected. You get a little bit of view of the people that are going to, some of the people from the team that worked on the MLC are going to speak today. You see them there, but let me explain a little bit the purpose of this technical webinar on the MLC. Now, during our last Tax Talks last week, Monday, we already provided a brief overview of the MLC, but we realized that there's a significant amount of rules that we released and that they are very novel. And so we plan to go a little bit more into the technical details about the design and the practical applications of these provisions today. And so how are we going to do that? We have 4 sessions. We will start with explaining the coordinated reallocation of profits under amount A. We will use a flow chart to do that. Then we will go into the benefits accessible to taxpayers under the tax certainty framework, and that is for amount A and for the issues related to amount A. We will discuss the removal and the standstill of DSTs and relevant similar measures once the MLC comes into effect. And then finally, and Hazel already alluded to that, there will be a Q&A session, and we will have already dealt with some of the questions during the presentation, I'm quite sure, but there will still be an opportunity to raise questions during the webinar, and then we see when we have time that we will deal with some of your questions. Now, just before we start, some practical things. There is some high-level information on the MLC and its content available on our website, and you can access it by clicking on the overview link when you go to the main page for the MLC. We have also updated more detailed information on the MLC with more details on content and key provisions, and you can find that when you click on fact sheet. And as Hazel already said, we will upload the slides that we use during the webinar. We will update the video of the webinar itself, so if you have colleagues that were not able to attend, they can look at it at a later stage. But let's start with the content now. And so, Eric, I'll give you the floor for the first session.
Thank you very much, Sandra, and hello to everyone. So if we move to the next slides, you will see here all the steps that we will take you through during this first session. And this is an attempt to basically identify, if you think about how you would comply with the amount A rules with this coordinated reallocation system that is contained in the Multilateral Convention, the MLC, the simplest is probably to break down those rules into the 5 steps that you can see on the screen. Very quickly, I can take you through this step, but obviously the purpose of this session is to take you through each steps in more detail. So the first step is scope, and this is about whether the multinational, the group, is in or out of this reallocation system. And as you know, we will get back to that. We use here mainly quantitative metrics to determine whether you're in or out. And the result is that this new reallocation system will only apply to very large and profitable multinationals. Then the second step, once you know whether you're in or out, suppose you're in a scope, you have to identify basically the eligible market jurisdiction. And what do we mean here by eligible market jurisdiction? We mean that you need to basically take your group revenue, sales, and you need to allocate them to your different markets using specific sourcing rules. And when you've done that, you will be able to establish among those markets where your revenue is allocated, those that are entitled to tax this amount A profit by virtue of a specific nexus rule. Now, once you've done that, you know where your revenue is allocated, where you derive your sales from, and you know which markets are entitled to tax amount A profit. You get to the next step, which is step 3 on the slide. And here, basically, you need to build a profit measure, which is the basis for the reallocation. And this computation is done at group level. We will come back to that. And what you're trying to do here under step 3, once you have your group profit measure, is to allocate a defined portion of the group's excess profits to market jurisdictions. And to do that allocation, you basically use formulas and quantitative metrics that we will explain during the session, including for the last sub-steps here that you can see on the screen, 3.3, which is about adjustments for double counting, which is the marketing and the distribution safe harbor. Now, when you've completed this step 3, you know where your amount A profit for the group is going, where it is allocated for each jurisdiction. Now, you still need to determine where that amount A profit comes from, if obviously you want to ensure that double taxation is eliminated. And to do that, as you can see, we use a metric, which is a key metric across the model, return on depreciation and payroll. We'll come back to that. And we use a tier system based on that metric to first allocate the relief obligations, the obligations to relieve double taxation at a jurisdictional level, before we have then rules to push down those obligations determined at jurisdictional level to specific group entities. Once that step is completed, you get to the last step, and basically once you've done all this, you know you have all the information you need to fill your amount A tax return and the related documentation package, which you can fill and submit in a single point, typically the parent jurisdiction, and then the parent jurisdiction will distribute that tax return and the related documentation to all the relevant jurisdictions. You will also have, once all this is completing, the information allowing you to pay your amount A tax in the different relevant jurisdictions, and you will be able to do that in most cases from a single point, from a single entity within the multinational. And finally, in parallel, the group entities I mentioned earlier that have been identified under step 4 to claim relief from double taxation will be able, obviously, in their respective jurisdictions to claim relief from double taxation arising from this reallocation system. Now, before we go into each step and look at the specific features, there may be a couple of general comments relevant when you look at all those steps together, when you actually look at the forest. And one is that something that is likely to strike you after going through this model is the novelty of some of these features in that model compared to the existing profit allocation rules that you're familiar with. This novelty has to do, for example, with the calculation, the computations, which are conducted at a group level in many instances for the purpose of scope. You would see it under step 1, but also to determine your what we call the allocation tax base, the basis for the allocation under step 3. Another thing also that is quite novel and that you will see a lot when we take you through this different step is the use of formulas and quantitative metrics, which is a constant across the model. Again, for the purpose of scope, as I mentioned earlier, that's a key criteria to determine whether you're in or out is purely quantitative metrics based on profitability and revenue. But also you will see when we get into, for example, step 3 about allocation of profit and the MDSH, the adjustment for double counting, mainly quantitative and metrics and formulas there, as well as when we get to step 4 and we allocate the obligation to relieve double taxation to 2 different jurisdictions. And maybe something that you will notice here is that regularly we use the same metrics, the same thresholds across the model. And something you will see that is very important, obviously, for the functioning of the model is the return on depreciation and payroll at group level and at jurisdictional level. And last thing maybe to flag there in terms of novelty is that related to all this, this reallocation system that we will describe applies on top as a layer, basically, on top of existing profit allocation rules. So it does not replace them. It will instead coexist with the existing rules, which is why using a multilateral convention, the MLC, which contains all those rules, is essential to implement this system, as well as the multilateral tax authority process that we will cover during the second session is essential to support its application. Because clearly, you want to be able to make this system work, you need to remove any obstacles that could arise from existing double tax treaties. But beyond that, you want to ensure a coordinated and consistent interaction of this model with your existing profit allocation rules. And that's obviously essential if you want double taxation to be effectively eliminated. Maybe another also comment when looking here at the forest is that as we go through the different steps, another thing that is likely to spring to your mind is a sense of complexity. And that's clearly because the model that we will that underpins this reallocation system is not easy to understand, and it's clearly the purpose of this webinar to try to unpack these rules and explain how they are intended to work. But maybe a few observations of this, just to put this into perspective. One is to mention that the reallocation system here that you see on the slide and that we will describe in more detail, which is contained in the MLC, in the Multilateral Convention, covers the full, so to speak, book of Amount A. That means it covers all the rules that are required to compute and allocate Amount A profit. And all those rules are within the MLC, with just a few exceptions that we will cover during this session. For example, to determine the rate, the CAT rate, which is applicable to your Amount A profit, or to the process that you need to follow to claim and compute the double tax relief that a group entity will be able to claim in its jurisdiction. But for the rest, or large extent, those rules are all within the MLC itself, which is obviously a difference with existing double tax treaties, which, as you know, for their application and to determine the profit that is being allocated, rely also to a large extent on the domestic rules of the respective jurisdictions. So if we take as an example, for example, a different book to tax adjustment that we will take you through under step 3 for the purpose of determining the group measure of profit, but also under step 4 to determine the jurisdictional measure of profits. These things, obviously, those different book to tax adjustment look complicated and will require some compliance work, obviously. But the fact that the MLC goes into such details and don't, leave room for other adjustments to be made for the purpose of those computations, for the purpose of computing the tax base, could turn out, further down the road as a simplification compared with the existing rules, with the existing double tax treaties, where you have to deal with multiple domestic rules, multiple systems to determine exactly the profit and the tax base that is the basis for the profit allocation. So that's one observation. I think another one also, which you will see as we go through a step, is that the model here that is contained in the MLC is expected to work largely in an automated fashion, meaning that there are a couple of inputs that will need to be built and that will require some compliance work. And here I'm thinking in particular, for example, on some difficult ones, some difficult data points, such as sourcing your group revenue under step 2, or computing your jurisdictional return on depreciation and payroll under step 4. But subject to those inputs, once you have those, when you've built them, and there's a certainty process obviously available to support that, you can basically put those inputs into the system, and the system, those rules, which are largely formulaic, will do the rest of the work for you and determine how much profit is allocated to each jurisdiction. I think that should be enough at that share when you look at the forest, and I don't want to delay any further the description of the different steps. So let's start looking at the trees now, the different trees, and if we move to the next slide, I think it's Jesse who is going to start with taking you through a scope.
Thank you very much, Eric, and hi, everyone. We'll start by talking through the step one of the process, the scope determination. And in most cases, determining whether an M&E is in scope is done by applying a group revenue and profitability test. But there are a few limited exclusions from scope for particular types of activities that will either take groups out of scope or change how amount A applies to them. And we'll talk through those as well. So on slide 8, you'll see the main scope test. It looks at both revenues and profitability. With respect to revenues, groups are going to be out of scope with respect to an accounting period unless their adjusted revenues exceed 20 billion euros in that period. Now, adjusted revenues are the revenues they report in their consolidated financial statements, exclusive of consumption taxes like VAT, and subject to certain other limited adjustments. We say here 20 billion euros is the threshold. That is the threshold when the MLC starts to function. After 7 years, there will be a review process that will ultimately lower that 20 billion euro threshold to 10 billion euros, assuming that the MLC has been implemented successfully at the end of that 7-year period. Once you've passed that revenue test, you're covered, again, only if your pre-tax profit margin for the period exceeds 10%. The pre-tax profit margin, that's your, the metric is the adjusted profit before tax divided by your adjusted revenues. And adjusted profit before tax is really your profit or loss in your consolidated financial statements of the ultimate parent entity of the group, subject to, again, a limited number of adjustments to make sure that those results reach an answer that's fit for the purpose of the MLC. If the group is below that 10% pre-tax profit margin threshold, then they are out of scope for the period. If they're in, to minimize the risk that a group that is generally out of scope will have a short-term fluctuation of profit that brings them into scope temporarily, there's an averaging rule, and it kicks in for groups that are above 10% profit margin for a period, but were out of scope for the previous 2 periods. And under that averaging rule, a group in that circumstance will be in scope only if they were above 10% profit margin for at least 2 of the preceding 4 periods, and only if the weighted average of their pre-tax profit margin measured cumulatively over the previous 5 periods exceeds 10%. So really just meant to address short-term fluctuations in profit to make sure that the rules still reach a sensible result. With respect to segments, and I see that we got a question about this, so that question was timely. If a group fails the profitability test overall, meaning it is below 10%, so not in scope as a group, but a disclosed segment of the group meets both the revenue test and the profitability test on a standalone basis, then that segment is going to be brought into scope, and there are special adaptations of the rules to ensure that it can apply sensibly to segments under those circumstances. As we said up front, there are limited exclusions from scope, and you'll see those on slide 9. And these are in 4 basic categories. Regulated financial services, where the exclusion removes from amount A effectively regulated financial institutions. So, for example, banks, insurers, asset managers, broker-dealers. To qualify, those financial institutions have to be licensed. They have to satisfy certain regulatory capital requirements, and they have to satisfy activity tests to make sure they're actually doing the things they're regulated to do. There's an exclusion for extractives activities, so groups that engage in extractives activities, meaning they undertake exploration, development, or extraction activities as principals on their own accounts, and they derive revenue that in the aggregate has a substantial connection with exploration, development, or extraction by the group. Those groups, which will typically be large oil and gas and mining operations, will be taken out of scope of amount A. There's an exclusion for the financial results of autonomous domestic business, meaning we exclude the results of entities located in jurisdictions in which an MNE's business is conducted autonomously from the rest of the MNE. So that consolidating and reallocating would lead to results that didn't make much sense. How do we determine autonomy? Well, there are quantitative tests that are used for the purpose. So you look at the ratio of group revenues sourced in a jurisdiction for the group, the sum of the third-party revenues of the entities located in that jurisdiction. You look to find effectively congruence between those two things. And you look at the level of cross-border intragroup revenues and expenses to make sure those are relatively low. So there's relatively little interaction between that autonomous domestic business and the rest of the group. Finally, we have an exclusion for supplies with a defense purpose. So defense exclusion. How do you determine that purpose? Well, you look at, the procurement or use. Is it procured or used by a government body that's created to perform defense or intelligence functions? Is the supply designated for use in defense or intelligence, or is it subject to export control regulations that are designed to protect that type of defense or intelligence security interest? And you look at things like whether the disclosure of information related to the supply is prohibited by laws that are designed to protect defense and intelligence related security interests. So looking at slide 10, these exclusions are grouped into two groups. We have the exclusions for regulated financial services and for extractions, where we remove the revenue and profits from these types of activities, and then we retest scope. So if after removing these profits, you would be below the 20 billion adjusted revenues and 10% pre-tax profit margin test, then your group is out of scope, and that's the end of your story. If you're still within scope, then we apply amount A, but only with respect to the revenues and profits that aren't covered by the exclusion. Moving on to slide 11, you'll see a different approach applied with respect to the autonomous domestic business and defense exclusions. There, we count the revenues and profits covered by these exclusions for purposes of the scope rule. But when we actually get around to applying amount A, those profits are excluded. And so the groups will still be in scope unless the in-scope profits after you apply these adjustments are below de minimis thresholds. And in all cases for these exclusions, groups will have the opportunity to make use of the certainty process through what's called a scope certainty request to make sure they know with certainty, with binding certainty, whether they are going to be covered by amount A. And so that's step one, determining scope. We can then move on to step two, identifying the eligible market jurisdictions. And there are three steps here. You categorize the group revenue and apply sourcing rules. You ultimately determine source using a reliable method, and then you determine in which jurisdictions you have nexus as a group. So beginning with the first of those, revenues are generally categorized based on the ordinary or predominant character of the transactions from which they derive, with substance prevailing over form. And you'll see on the slide the various categories of group revenue. So you have categories for finished goods, for digital content, for components, for intangible property, for 9 subcategories of service covering a wide variety of different services, for user data, for immovable property, for government grants, and for non-customer revenues, a sort of catch-all. And so for each category, you'll identify an applicable sourcing principle, and those are set out, by category in the MLC. So for example, for finished goods, the sourcing principle is the place of delivery to the final customer. So revenues are sourced based on where the goods are delivered to the final customer. So for online advertising, as our second example on the slide, you look at where the viewers are located, and that's the jurisdiction in which the revenues from that activity are going to be sourced. Moving on to the next slide. for purposes of actually determining source, an M&E needs to apply that sourcing principle using a reliable method. And a reliable method is one that's based on what we call reliable indicators, or in some cases, allocation keys with preference given to reliable indicators. And what's a reliable indicator? Well, it's information the M&E has available to it that satisfies certain reliability tests. And so, for example, you might have information that you're actually using in your business for commercial purposes, for regulatory purposes, for legal purposes. And if so, and if it generally gives you reasonable results that correspond to your sourcing principle, then you get to treat that as a reliable indicator and use that to source your revenue. Allocation keys, in contrast, generally are only usable if they're specifically allowed in a particular rule, and generally only if reliable indicators aren't available. So instead of using specific indicators from your business to determine source, you'll apply some sort of macroeconomic proxy, like the relative GDP of the jurisdictions involved. In general, determining source using reliable method isn't done transaction by transaction. So revenues from transactions can be aggregated. And the key is to establish methods that on a systemic basis are reliable. And that approach can be confirmed by the M&E in a binding fashion through the certainty process by making an advanced certainty request. And we'll talk about that certainty process a bit more later on. There are also transition rules in the short term to make sure that while M&Es are getting up to gear, finding reliable indicators, getting those advanced certainty requests, and making sure that they're able to operate the rules the way they're intended to operate them, they'll in the short term be able to rely more on allocation keys without a problem. And finally, we have a backstop in the form of a default allocation key. So default allocation keys apply, and they vary depending on the type of transaction, but they'll apply where no reliable method is available or no reliable method has been applied, and that functions as a backstop just to make sure that all revenues ultimately end up being sourced one way or the other. In slide 15, you'll see an example here. The example focuses on finished goods through an independent distributor. So an M&E sells goods through an independent distributor, and the source rule is where the goods are delivered to the final customer. And there are a variety of indicators that are sort of specified in the MLC as indicators that are considered appropriate to use. And those include, information on the delivery address of the final customer, information on the retail storefront through which the goods are going to be sold, or other indicators that have characteristics that make them reliable. And there are also some allocation keys that can be used in the situation in which no reliable indicators are provided. And you'll see those on the slide. They include a regional allocation key and a variety of others that I think we won't go into because they end up getting quite complicated to cover all of them, but for purpose of an example. But here, in our example, you have an M&E that knows the location of the retail stores through which its goods are being sold, and that accounts for 60% of the revenues they get from selling the goods. And so there they have reliable indicators and can use the location of the retail storefront to determine conclusively how the sourcing principles will be applied. For another 30%, they know the delivery address of the final customers, and so they've now sourced 90% of their revenue by applying reliable indicators. For the rest, an M&E might be able to demonstrate that the remainder of those revenues are in a particular region, and if so, that we then have a regional allocation key that they can use to allocate within that region using final consumption expenditure in each of those jurisdictions. And so by applying all of those together, the M&E is able to source 100% of its revenue, not all using reliable indicators, but using a mix of reliable indicators and allocation keys. Having done all of this work to determine source, you then use those sourced revenues to determine nexus within a particular jurisdiction. So profits don't get allocated to a jurisdiction unless it exceeds a nexus requirement, and an M&E and is treated as having nexus in a market jurisdiction if the aggregate revenues that are sourced in that jurisdiction are equal to or greater than 1 million euros, or a lower threshold of 250,000 euros for certain jurisdictions that have GDPs of less than 40 billion euros. So lower income jurisdictions. With that, I think that gets us through step 2, and I'll turn it back to Eric to talk about calculation and allocation of profits.
Thank you, Jesse. And so basically we get to step 3 here. So we know whether the group is in scope or not. We know where it derives its revenue, and which are the markets that are potentially entitled to tax the amount A profit. Now we get to the point on the step 3 where we have to calculate the measure of profit, the group measure of profit, and allocate it to the different market jurisdiction. So if on the next slide, you will see first that obviously the starting point here is to compute your relevant measure of a group profit, which is the basis for the reallocation. Here you will see that the rules broadly rely on what is reported in the consolidated financial statements of the group, with just a couple of adjustments, as you can see here on the screen, to that reported profit. Maybe a few adjustments here to flag is that, as you can see, all dividends are out of the bet, so they're taking out. So is also capital gains from shares, so that they're taking out of a tax base. The term that you can see here on the screen, asset gain or loss spreading adjustment, just refers to the fact that when you have, a one-time gain from the sale of an asset, which may trigger a significant profit or loss, that significant profit or loss is typically spread across multiple years to avoid that it artificially impacts your profitability in a given period. Another maybe adjustment to explain here at the end of the second box is the acquired equity basis adjustment. It sounds a bit cryptic as a term, but it actually just refers to basically rollover rules that we are quite familiar with. Rollover rules for acquired shares in response to the exclusions that I just mentioned, the fact that capital gains from the disposal of shares are not included in the tax base. Therefore, there are here some rollover rules to ensure that there's no step up in basis when the shares are acquired by an in-scope group. Maybe also worth flag is the treatment of losses, which are taken into consideration here for the purpose of this group profit measure. Obviously, we are not talking about here losses incurred in the period itself, because if you go that far into the model, that means that you are highly profitable. So we typically talk about earlier losses incurred in past periods, which can be carried forward and offset against the profit, including losses, for example, that would have been transferred to the group as a result of a business reorganization. And maybe last thing to mention here, as you can see, among those different adjustments, there is no adjustment for non-controlling interest, meaning that profit attributable to non-controlling interest are kept within this tax base. Now, if we go to the next slide, you have determined your measure of group profit at a global level. Then you have a 3-step formula to determine how much profit is allocated to each jurisdiction. If you start from the left side of the screen, the first component, the first step of this formula is the profitability threshold. And here we're basically using the same threshold that was already described by Jesse in the context of scope, which is 10% of your group revenue. And that's the amount that would be subtracted from your group profit so as to be able to identify your excess profit at group level. So that takes you to the second component here on the screen. And what you do here is that once you have your excess profit measure at a group level, you apply the reallocation percentage, meaning it's only a defined portion of that excess profit, what is the profit above 10% revenue, that is potentially subject to reallocation under this system. So now you have basically the total amount A profit at a group level that is potentially available for reallocation to different market jurisdictions. So you need to get to the third component here on the right side of the screen, which is the allocation key, which obviously is based on local sales, meaning revenue as sourced under the rules described by Jesse earlier. And the result is that the portion of the total amount A profit that a market will get will be similar to its ratio of locally sourced revenue to total revenue of the group. And obviously, this is only relevant for jurisdictions that have satisfied the nexus threshold that was mentioned by Jesse earlier under step 2. Then you're not completely done yet in terms of identifying how much amount A profit is allocated to each jurisdiction, and you still need to go through a last step. And here, and that's the marketing and distribution safe harbor, which is typically referred to as the MDSH. The slide on the screen here gives you the full picture, a full description of the different steps involved here and of how the mechanism, the MDSH works. Before maybe taking you into those, into the mechanic, into those different steps, maybe just worth clarifying what this is about, what the MDSH is basically trying to achieve. This is relevant, obviously, in a case where some amount A profit is allocated to a jurisdiction, otherwise it's not relevant. And where some amount A profit is allocating, the MDSH is basically about verifying whether such allocation of amount A, which is a portion of the group's excess profit, whether such allocation could be duplicative with some taxing rights that the market jurisdiction already has under existing profit allocation rules, meaning that basically the market jurisdiction would be able to tax some excess profit of the group under existing profit allocation rules, and on top would receive some amount A profit and would be able to tax it. And obviously the intention with this coordinated reallocation system is to allocate amount A profit to jurisdictions that do not currently have taxing rights over any excess profit of the group under existing rules. So this is what the MDSH is about, trying to avoid what we call double counting, a duplicative, basically, taxing right over the excess profit of the group in a given market jurisdiction. Now, in terms of how this works, unlike the prior steps that I described, which relies on group calculation of the level of group, here we're shifting to a jurisdictional measure of profit under the step 1 that you can see on the screen on the left side. Given that obviously what you're trying to do here, what you're trying to assess is whether is to look at the profit that sits in the jurisdiction that is potentially taxed, to assess whether there's any excess profit in those jurisdictional profits that could be duplicative with amount A profit allocations. And to compute that jurisdictional profit under step 1, we start from a locally booked profit and we make some adjustment. And I will come back to that. But here we're using, we are building on rules that are already applied for the purpose of elimination of double taxation and rules to determine a jurisdictional profit measures that will be described later by Chris. So we start with locally booked profit, we do some adjustments, and you will see it's mentioned here, but I will come back to that later. We add to the mix, to the computation of the jurisdictional profit, potentially the, if any, withholding tax collected by the market jurisdiction if those withholding taxes are collected on cross-border deductible payments. But I will come back in more details into that later in the presentation. So under the first step, you have a jurisdictional measure of profit. You have an estimation of the profit that the market jurisdiction can potentially tax. And once you have that, you need to verify two things, which are basically step 2 and step 3 here on the screen. First, step 2, you need to verify whether this amount of jurisdictional profit is material enough to justify applying and the compliance work associated with the MDSH. So that's a de minimis threshold. And it means that if your amount of profit in the market determined at the step 1 is below 15 million, you stop there. The MDSH adjustment doesn't apply, and you stop there applying the rules. Now, if the jurisdictional profit that sits in the jurisdiction under step 1 exceeds 50 million, then you need to verify something else, which is step 3, and that's obviously whether there is any excess profit in that profit amount, whether there's any excess profit in the jurisdiction. And it's only if there is excess profit in the jurisdictions that you go to the next step, the last one, which is determining the MDSH adjustment. So how do you test? How do you measure whether there is any excess profit in the jurisdiction under step 3? Well, there is actually really two thresholds with a primary metric within those thresholds, which are here on the screen shown in bold. The RDP threshold, which is really the primary metric. So it's a return on depreciation and payroll. And we'll come back to that, but it's the same metric that we apply for the purpose of the MDSH here, but also for the purpose of elimination of double taxation. So what is it? What is this RDP threshold, which, and you can see there's a formula here on the screen. You basically start with 10% of group revenue, which is, as you know, the threshold that you use for the purpose of scope. So it's an existing threshold. And it's also the threshold that you use for the purpose of profit allocation, when it's 10% of group revenue, and you divide it by the group depreciation and payroll. And what that operation is effectively doing, it's converting those 10% of group revenue into a group return on depreciation and payroll. And that's the final threshold, which is specific to each group, obviously, because each group have a different level of depreciation and payroll. And that's the threshold that you apply to your local depreciation and payroll in the jurisdiction to determine the absolute amount of profit that is deemed to be the normal profit measure, which is basically needs to be exceeded in order to recognize excess profit. Now, there's another threshold potentially, which is described, as you can see on the screen, as the RR floor. And that may indeed apply in some instances if it's higher than the RDP threshold that I just described. And as you can see, the percentage is 3% multiplied by locally sourced revenue under Amount A rules. And this percentage could be seen as quite low compared with, the 10% group revenue that is used as a starting point to determine the RDP threshold. But that's because the purpose of the RR floor is only to cater for the specific instances, quite limited circumstances, where applying the RDP threshold to the activities of a group in a given jurisdiction would lead to an artificially low normal profit amount. And that's because the DP situated in the group's DP situated in the jurisdiction is extremely low. And that's a scenario you can see when, for example, for certain marketing and distribution activities where the local presence that is needed to support the local sales is extremely small and gives rise, therefore, to very small depreciation and payroll. In those cases, then you could see that RR metric, this floor, kicking because it may be higher than the primary RDP metric. Now, beyond those two thresholds, and the primary one being RDP, you will also note here on the slides that there may be, in addition, a specific adjustment, but that's only in instances where you have withholding taxes that are taken into consideration as part of the MDS. It's where withholding taxes are put into the mix of the calculations, that you have a specific adjustments that apply here. And this is something I will come back to in another slide. So when you have applied your threshold, when you have completed step 3, you basically have determined whether there is any excess profit in the jurisdiction. And if that's the case, you go to the last step here on the slide. And here under step 4, you have to determine what portion of the excess profit is going to be offset against your amount A allocation, what we call the MDSH adjustment under the MLC rules. And you will see, and I will come back to that, that here there is an activity test, which actually is not a qualitative assessment, it's a quantitative metric, but it's an activity test that will determine what offset percentage you have to apply to a given jurisdictions. And that offset percentage can be 90%, so quite significant. It's 90% of the excess profits identified in the jurisdictions that will be offset against amount A allocations, or it could be lower, it could be 35% of the excess profit that is being offset, including lower to 25% in the case of certain developing countries that qualify as low income and lower middle income economies as per the World Bank classifications. But I will come back to that. And so you have here the full picture, I think, the full description of the mechanism. And I will try now in the next slide to go a bit deeper into each of those steps. So let's start with step 1 and 2 and clarify certain aspects here, including how withholding taxes are taken into consideration in the mix. So the first step, as I mentioned, is to determine your jurisdictional measure of profit. And you start here with the profit measures that you have determined for elimination purposes. And that's something we call the elimination tax base, and that Chris will describe later as part of step 2. What this is, at a very high level, is basically pulling together the profit of the multinationals that have been booked in the jurisdiction with a number of book to tax adjustment to get closer to what is typically a corporate income tax base. As part of these adjustments, that's where we take some withholding tax into consideration in the mix. And where there's a withholding tax collected by the market jurisdiction on a covered withholding tax, meaning a withholding tax on a cross-border deductible payment, then you do an upward adjustment to account for that withholding tax in the computation of the jurisdictional profit. And here maybe just worth clarifying a bit what the approach here. So first, the suggestion here is that those withholding taxes, those covered withholding taxes, which apply to cross-border deductible payments, are a first level of taxation of corporate profits. And like other taxing rights on business profit, whether it's based on transfer pricing or PE, permanent establishment rules, need to be taken into account to assess how much basically profit of the group sits in the jurisdiction and can be taxed by the market jurisdiction. Now, how do you do that? How do you put them into the mix? Well, it's a tax amount, so you need to convert the withholding tax into a profit amount, and that's done through a formula, which is described here on the screen. Quite simple. You just take the withholding tax collected, the tax amount, and you divide it by the CAT, the corporate income tax rate of the source country, the market country that has collected the withholding tax. And what this is doing is basically trying to approximate the amount of net profit that the market country is effectively taxing through the withholding tax, and then feeding this amount of profit into the MDSH calculation. So to summarize, in a scenario where the market jurisdiction has both locally booked profit of a multinational, because there are some local subsidiaries which are taxable in that country, but also collects withholding taxes on some cross-border deductible payments, whether these payments are intra-group or third-party payments, by the way. If that's the case, then the jurisdictional profit will be the sum of those two elements the locally booked profit with some adjustment and the withholding tax collected converted into our profit amount. And it's the sum of these two elements that you will then test against the other steps, the other elements of the mechanic. And obviously, the next step, as you know, is the de minimis threshold. And so it's the sum of the two that you will test against the 50 million threshold. Then, if we move to the next slide, you will see here the next step, as you know, which is computing, determining, assessing whether there's any excess profit in the jurisdiction. We have already gone through the general rule, which is the first bullet, you know, the two thresholds that we have with the higher of the primary threshold based on RRDP and the supplement based on a return on revenue. Now, in the case of withholding taxes being taken into consideration within this mechanism, you need also to apply a specific rule, a specific adjustment to the converted amount that you have computed as a result of the withholding taxes. And this is referred to as the reduction factor in the MLC rules. And it's basically an adjustment to your profit converted amount that you have computed for the related withholding taxes, or the upward adjustment as we really good described. So the upward adjustment is going to be reduced by a defined percentage. And that's the reduction factor. Why is there such a rule? It starts basically from the view that the other threshold, the general threshold that I described based on RRDP and ROR, do not necessarily deliver an appropriate outcome when they are applied to withholding taxes, especially if you look at withholding taxes in isolation. So suppose a scenario where basically the withholding tax is represent the main taxing right of the market jurisdiction. So when you do the computation, the withholding tax and the converted profit amount will represent all or substantially all the profit that is recognized in the market jurisdiction. You have an example here on the screen of such a scenario. So suppose a jurisdiction collects 10 million of withholding tax, the gross payment being 100 million, so it's a 10% withholding tax. If you apply the formula to identify the converted profit amount, you will obtain an upward adjustment of 40 million. So that's what you put in your jurisdictional profit for the purpose of the MDSH calculations. Now, if we assume that there is no other profit booked, for example, by the multinational in a jurisdiction, so 40 million is the only profit that you recognize in the market jurisdiction under the MDSH, then obviously the RRDP threshold, if you apply the RRDP threshold to that jurisdiction, given that there is no depreciation in payroll associated with this taxing right, you're just going to have a zero normal profit to subtract from your jurisdictional profit. And if you use your RR threshold, which is a 3% of locally sourced revenue, you're likely to have a normal profit measure of 3 million, given that in those instances, we're talking typically about third-party payments, the basis for the withholding tax and the basis for your RR metric are likely to be the same. So here in that particular example, out of 40 million of profit recognized in the jurisdiction under the MDSH calculations, 37 million of profit would be treated as excess profit if you only applied the general rules. And that's where the reduction factor comes in and apply some specific cuts, adjustments to that amount to recognize an additional amount of normal profit. So if you go, if we look at the next slide, you will see that in terms of mechanics, the reduction factor has been designed with a percentage that are basically adapted to the perceived challenges raised by the two MDSH thresholds. And that's why you can see here that basically the cut, the reduction percentage gets bigger when the local DP is smaller. So 60% cut where there is no local DP within the jurisdiction applies to the upward adjustment. 30% cut would apply in a scenario where there is some DP, but that DP is relatively low compared to the DP of the group. And here we will come back to it. We use a metric that is actually the same metric that we use later on under the MDSH to differentiate jurisdictions with respect to the offset percentage. And finally, 19%, so a much smaller cut reduction percentage in the scenario where actually there is quite significant DP in the jurisdictions that collects the withholding tax. And therefore, it is expected that the general threshold, the general rule, the RDP threshold should work as intended. And last thing here maybe to mention is that to account for the specific circumstances of some developing countries, low income and lower middle income economies as per World Bank classification, which, as you know, are typically, because of capacity issues, more reliant on withholding taxes than other countries. Those reduction factors are increased from respectively 60% to 70% when there is no DP, and 30% to 40% when there is some DP, but that DP remains quite low relative to the group average DP to sales ratio. Now, last element that we wanted to cover with respect to the MDSH, if we move to the next slide, is related to the last step, and the different offset percentage can apply. And here, as mentioned earlier, we have an activity test that is used to set the portion of the excess profits that will be offset. And we have two categories basically of market jurisdiction. Those with predominantly sales-related local activities, meaning mainly marketing and distribution activities being conducted in the country, where the offset percentage is higher, 90%. And that's because the local excess profits that you identify under the prior steps would typically be related to those marketing and distribution activities. So the duplicative nature of that excess profit with amount A is clearer, and this is why you basically apply a higher offset percentage of 90%. For the other category of jurisdictions, in contrast, where basically the conclusion is that there are activities in the jurisdictions that go beyond just marketing and distribution, the offset percentage is lower. 35% as a standard percentage, potentially reduced to 25% for low income and lower middle income economies. And here the idea, the suggestion is basically that because there is a mix of activities taking place in the jurisdiction, if you identify excess profit under the calculations that I described, that excess profit is not necessarily related to local marketing and distribution. And therefore you apply a partial offset to when you compute your MDSH adjustment, when you offset that excess profit against your amount A allocations. Obviously important to flag here is that to differentiate those two jurisdictions, those two categories, we use a quantitative approach, which draws on the activity test that was proposed by many commentators during the last public consultation. So this metric is the ratio of local depreciation and payroll to sales. So here it's a depreciation and payroll to revenue ratio, not to profit. It's not a question of profitability. It's really a question of how much revenue under amount A rules you derive from a jurisdiction, which is the metric that is used here to distinguish the two. And if that ratio at a jurisdictional level is lower than 75% of the average ratio of the group, a similar ratio, you know, a group depreciation and payroll to group sales, then if you're below that threshold, the country, the market jurisdiction will be deemed to have predominantly marketing and distribution activities, and therefore would be subject to the higher offset percentage. So clearly here, when you look at the activity test that is used here to differentiate those two categories of jurisdiction, no qualitative assessment of the activities or functions performed. It's a quantitative metric that is used. So I think this covers all the different aspects of the MDSH. The last step that applies to calculate and allocate your amount A profit to a given jurisdiction And once you've performed this, once you've gone through those rules and you've completed step 3, you basically know how much amount A profit is allocated to each market jurisdiction. And you then need to go to the next step, which has to do with elimination of double taxation. And I will hand it over to Chris.
Yeah, thanks very much, Eric, and hello to everybody. So as Eric mentioned, in the preceding steps, we've allocated amount A to markets, but of course we don't stop here. We need to eliminate double taxation with respect to amount A, and that's on the basis that amount A, of course, is intended to operate as a redistribution of taxing rights. And so, of course, we need to identify an equivalent relief amount that is equivalent to the amount A profit that's been allocated to markets, and we need to allocate that relief amount to relieving jurisdictions. And the intention here is to allocate those relief amounts to the most profitable jurisdictions. And importantly, I'll reference back to the tax talk of last week when David Bradbury in his address mentioned that under the existing modelling, approximately 70% of the relief under our modelling is allocated to investment hub jurisdictions. So just quickly on the, I'll move forward to the next slide. So first of all, we'll talk about here the elimination tax base. And this is that jurisdictional measure of profit that is applied for elimination of double taxation purposes. Here we seek to identify where taxing rights are currently allocated under existing laws. And maybe that's going to be sort of a familiar concept to folks in the context of Pillar 2, because of course in Pillar 2, we determine our jurisdictional tax base with the intention of approximately identifying where profits are currently subject to tax under existing profit allocation rules. And so therefore, really our elimination tax base, as we'll talk through here, leverages a lot of that technology from Pillar 2. And importantly, in that sense, will enable MNEs to use the work that will be undertaken for Pillar 2 purposes to put that to effect in determining the elimination tax base for Pillar 1. So here, working through the steps from left to right, on the left-hand side, consistent with Pillar 2, we identify all entities, group entities located within a given jurisdiction. And for all such entities in the jurisdiction, we aggregate the accounting profit as per consolidated financial statements. And that's our starting point in terms of a jurisdictional profit per jurisdiction. We then, of course, make a number of adjustments to that accounting measure of profit, consistent with P2. And as mentioned, the reason for that is to align with corporate income tax bases that we observe internationally. The first bullet point under that middle box here that we describe is those adjustments mentioned in slide 18 in the allocation tax base that Eric talked about. We apply those similarly in the elimination tax base. We also make a number of further adjustments, and we list a few of them here. This isn't a comprehensive list. There are indeed other adjustments that are largely consistent with P2, but we'll go through a couple of them here. So first of all, taxable presence adjustments. Of course, here, given that we're seeking to attribute profit to jurisdictions where they're subject to tax, to the extent you have a group entity, but part of its profits are actually subject to tax in another jurisdiction because they're subject to tax, let's say in a permanent establishment, we actually reassign said profit from the location of the group entity to that taxable presence location. We also apply transfer pricing adjustments to the extent that the income or expense recognized for a given intra-group transaction for accounting purposes does not match the transaction value for tax purposes, so we apply adjustments there. We also apply loss carry forwards. Of course, it's very common for corporate income taxation systems to recognize carry forward losses. And finally, and importantly, picking up on the discussion that Eric led on the withholding tax upward adjustment in the context of the MDSH, we recognize a withholding tax downward adjustment here in the context of EODT. And I do want to make sure that I'm clear here. So this adjustment that we apply for EODT, given that for MDSH we use this elimination tax base as our starting point, this withholding tax downward adjustment would therefore be relevant also for MDSH. Now, this withholding tax downward adjustment applies with respect to covered payments that are received by group entities and subject to withholding tax. In those cases where there is double tax relief granted in the residence jurisdiction that received the covered payment. In those cases, the residence jurisdiction would be considered to be giving up its taxing rights with respect to group profit to the extent it does offer that double tax relief. And so a adjustment is made starting with the withholding tax that was imposed, and we perform an adjustment, a conversion to convert that tax amount into essentially a profit converted amount. Finally, on this slide, on the right-hand side, we introduce this concept of a de minimis test that applies for elimination of double taxation. And this is particularly important for developing countries and smaller countries. And we list a couple of tests that are there. There's a two-pronged test. And if a jurisdiction satisfies either of those tests, it will be considered to satisfy de minimis and therefore may be in the mix for EODT. But if it doesn't satisfy either test, it will not be allocated any EODT responsibilities. And we have an absolute $50 million profit threshold with a specific adaptation around an anti-avoidance rule, and that's the second bullet. And we also have a further rule, the first bullet here, that refers to the smallest group of jurisdictions that comprises 95% of the group's profits. Moving on to the next slide, and here, next in the process, we convert the absolute profit amount that we talked about at the previous slide into a measure of profitability. And that allows us to identify and then allocate relief amounts to those most profitable jurisdictions in the group. And for that purpose, we need to identify the relevant profitability ratio, and that is defined as the RODP, otherwise the return on depreciation and payroll. We use an RODP metric on the basis that D&P, depreciation and payroll expenses, are considered to be the best proxy for economic substance in a given jurisdiction. And so therefore our RODP measure is essentially measuring profit relative to economic substance. In order to calculate that RODP, just quickly the steps listed on the slide here, we identify the depreciation and payroll of all entities in a given jurisdiction as per the consolidated financial statements. We make some adjustments to them, primarily, and we mention this as an example here, related to attribution of D&P expenses to taxable presence locations in those cases where we've actually allocated entity profits to taxable presence locations. So we seek to sort of match D&P expenses with related income. And finally, once we've calculated that adjusted D&P, we have the tools we need to calculate our jurisdictional RODP, which is the measure that we use going forward in the tiering system. So on to the next slide, please. Here we introduce the tiering system for EODT, and that's the system that we use to allocate relief to the most profitable jurisdictions. So first, we categorize each jurisdiction of the group as fitting within one of these tiers or maybe below the tiers, and then we allocate a profit amount to each tier. And importantly here, just to mention that these tiering thresholds are sort of calibrated to the characteristics of the group. So a group with relatively low D&P expenses, and therefore likely a group with relatively high RODP, the tiers will sort of calibrate upwards accordingly. So we're sort of comparing apples with apples here, and I think that's an important observation. In terms of the tiers, we list the tier thresholds here down the right-hand side of the page. So jurisdictions with profits greater than 1,500% or 15 times effectively the group's RODP will be in tier 1. And so these are really, if you think about it, very highly profitable jurisdictions relative to economic substance. We then have jurisdictions in tier 2, and those effectively have an RODP greater than 1.5 times the group's RODP. Then we have, and we've grouped them here, we've bifurcated them here, but we essentially have tier 3. And those are jurisdictions which have profits in excess of 10% of group revenues divided by group D&P. And I wanted to make a sort of draw attention to this threshold because it's also the threshold that Eric mentioned in the context of the RODP metric for the MDSH. And I did notice we got an online question around this in the chat. So I wanted to make sure I touched on this. So this measure at the tier 3B threshold, essentially, that we're showing here, the 10% of group revenues, that's going to be that proportion at a group level of profits that are considered normal profits from the perspective of our overarching amount A system, which says that any profits below are normal profits. We divide that by group D and P, and that allows us to identify a relevant RODP measure for the group that essentially is equivalent to normal profits. We also have here, you'll see at tier 3A and 3B, we have a staggering, and so that 3A threshold kicks in at 40% if the lower 3B threshold is less than 40%. Moving on to the next slide, please. So here we describe, after categorizing jurisdictions, we now allocate the total relief beginning in the top tiers. And the total relief, importantly, and I think we touched upon this at the outset, the total relief will be equivalent to the total amount A allocations to markets. So first at tier 1, we use what we call a waterfall approach, and we seek to allocate profits first in tier 1, and importantly under this waterfall approach, first to the most profitable jurisdiction in tier 1. And so the way this works is that the highest RODP jurisdiction will be allocated relief amounts until its adjusted RODP matches the RODP of the next most profitable jurisdiction. And then those two most profitable jurisdictions are allocated further relief amounts until their adjusted RODP matches the next most profitable jurisdiction, and so on. And we apply this methodology until either we fully allocated relief allocations of the group or tier 1 profit is fully utilized. Supposing that there remains allocation amounts that haven't been fully allocated out at tier 1, we move to tier 2. And at tier 2, we actually apply what we call a pro rata approach here. So allocation amounts that need to be used up in tier 2 are allocated to jurisdictions with profits in tier 2 relative to their respective excess profit in the tier. And a similar approach is adopted at tier 3A and then at tier 3B if necessary. On the next slide, we have a very simple practical demo to hopefully bring this to life a tiny bit. And here, please excuse the license taken on a highly simplified example, but we have here a scenario where a total amount A is 500 million euros, and very simply we assume that's all allocated to jurisdiction A, and then we have two potential relieving jurisdictions both with profits in tier 2 and tier 3A. Working our way down the schedule, the amount A allocation of the group is 500, so we seek to allocate relief amounts of 500. In tier 1 we have no excess profit, so we cannot allocate any relief amounts in tier 1. We come to tier 2 and the excess profit is actually less than the amount A relief amount that we're seeking to allocate. So tier 2 profits are going to be fully consumed, and you can see that there, that the excess profit and the relief at tier 2 is equivalent. We then come to tier 3A, and as you can see, tier 3A excess profits exceed the remaining 100 of relief that needs to be allocated. And so therefore we apply that pro rata approach. We see, for instance, that jurisdiction B contributes 40% of the tier 3A excess profits of the group. And so therefore we allocate 40% of the 100 to jurisdiction B, and the remaining 60 goes to jurisdiction C. And then at the very bottom, you can see the net position that results. On to the next slide, please. And here, so finally, we discuss the system to push down jurisdictional relief to entities or taxable presences in a jurisdiction. So what do I mean by that? Essentially, the amount A elimination of double taxation system to date on those slides described thus far have all been on a jurisdictional basis. But of course, the existing corporate income tax system that jurisdictions have in place is typically on an entity basis. And so therefore we need a mechanism to translate those jurisdictional relief allocations to entities. And so to do this, first of all, each jurisdiction actually will nominate the relevant profit measure that it chooses as its profit measure that will be applicable to it for amount A elimination purposes for push down here. And that particular measure of profit as selected by jurisdiction A would apply across the board for all M&Es for their relief push down under amount A in that jurisdiction. Once we've identified that relevant profit measure out of those three profit measures on the left-hand side, the approach to allocate from the jurisdiction level to entities or taxable presences in that jurisdiction essentially follows that waterfall approach that we talked about above in a jurisdictional allocation context. But importantly here, the allocation using the waterfall would be based on absolute profit as opposed to RODP. And there is, of course, no tiering in that waterfall system, so it all applies on a straight single waterfall basis. I would just mention one final point, that the last bullet that's in the note at the bottom here, that the last sentence therein, that the jurisdiction can bilaterally agree with a particular M&E to apply another method to that M&E, so that the jurisdiction and the M&E are free to agree if it's in the best interests of both parties on a particular given scenario to apply a different basis. And with that, that's your briefing on EODT, and I'll hand it to Laurent. Thanks very much.
Thanks very much, Chris. And I will now cover the administrative part of Amount A. And maybe just first to stress that this is an area where there was a lot of public input in the public consultation after the October 2022 progress report. And so there was really an effort to streamline the system and minimize administrative burden for companies and tax administrations alike. And this is what I'm going to describe in the next few slides. So first, the filing obligations. So there is a streamlined compliance process that will apply in most instances. And so this relies on a couple, which is really important in the administration of Amount A. So on the company side, you have the designated payment entity, which is typically the ultimate parent entity of the group. And it's another entity only if the ultimate parent entity resides in a country that is not a party. And on the administration side, you have the lead tax administration, which is typically the administration of the country of residence of this UP. And so there will be a possibility of a single filing of the amount of tax return and the documentation package by the designated payment entity to the lead tax administration. And it means that streamlined compliance means that through this single filing, it meets the obligation that the company has in every market jurisdiction. And because the lead tax administration will share the amount of tax return with the market jurisdictions and the relieving jurisdictions. So the lead tax administration acts as a single point of contact. And there will be, as I said, a single tax return, the amount of tax return, and there will be a template that will be developed by the Conference of the Parties, but the MLC already outlines the main elements that you can see on the slide, the financial data, the data which is useful to compute relief, and also this is where you can put your request for a certainty review. So the only exception to streamlined compliance is where actually the company already has an income tax obligation in the jurisdiction, in the market jurisdiction, and so then it's still and there is an interaction between the domestic CIT and the amount of taxation when the amount of taxation is not taxed as a separate levy. And so in this case, there will also have to be a separate filing in this jurisdiction, but this is only in the case where the company already has a filing obligation in this jurisdiction. So in a way, it is not a new obligation. So now moving to the payment, which is on the next slide. So this is a single taxpayer model. And this is important to stress because in the public consultation, the inclusive framework was still considering two options, the single taxpayer model and the multiple taxpayer model. And the feedback was really that the single taxpayer model was simpler to administer because it avoids a myriad of interactions between all the relief entities of the group and the market jurisdiction. So here you have a single entity of the group, typically the UPE, which will make the payments to every market jurisdictions. And a key element which goes with this is that the single payment entity will be compensated by the relief entities. So the relief entities get the relief, but to get it, and this is a condition that is set out in the MLCs, they will have to compensate the designated payment entity in proportion to their share of the relief amount. So this is the default scheme, but the groups will have the possibility to arrange the funding differently through a covered groups amount A funding agreement. So single payment of tax by the DPE and funding of the DPE by the relief entities. And also important to highlight is that these compensation payments from the relief entities to the DPE will be disregarded for every tax purposes, either in the relieving jurisdiction or in the DPE jurisdiction. And this is granted by the MLC. So now you can see the timeline of these different steps on the next slide. So we start from the end of the covered groups period. And so you have a filing timeline, which is between 9 and 12 months. Basically, this will be set by the jurisdiction of the lead tax administration. The filing deadline that it determines in its legislation will apply to the groups which have their UPE in this jurisdiction. And so that's the filing deadline. And then you have the payment deadline, which is in case of streamlined compliance, which is the most frequent instance. It is 18 months after the end of the period. And now the final step is the double tax relief process. So here there is a bigger part of domestic implementation in domestic law because double tax relief systems are quite different from one jurisdiction to another. And so the MLC recognizes a certain degree of flexibility to provide relief for double taxation for amount A, but still it includes a number of guardrails to guarantee effective and timely relief. And this was also a strong request from stakeholders in the public consultation. So the MLC first defines the relief methods that a relieving jurisdiction can use. So there are 4 methods: the direct payment, so refundable tax credit, non-refundable tax credit, and the deduction, which is a deduction of the profit amount that has been allocated to the relief entity identified as Chris described just a few minutes ago. Then the process, here it's a domestic process, because the relief entity is an entity of the relieving jurisdiction, so it already has an interaction with this tax administration, and so relief is claimed by its relief entity through the domestic tax process of this relieving jurisdiction. And then you have a number of guardrails, and first there is a timeliness guardrail, and so each relieving jurisdiction will have to either allow the relief to be provided in the installment payment of the tax, which is immediately the next one, or if it doesn't use the system, for example, if the jurisdiction doesn't have an installment payment system, there is a deadline of 90 days after a valid claim is submitted. And also to guarantee effective relief in case the relief cannot be fully utilized in the relevant period, in case there is not enough tax liability. And so this is typically relevant in case of non-refundable tax credit or deduction. Then the relieving jurisdiction has to allow the carry forward for a minimum of 3 fiscal years. So this is the processes, administrative processes. Just to pick one of the questions that has been asked in the Q&A, what happens in case one of the relieving jurisdiction is not a party to the MLC? In that case, it will not have, of course, any obligation to provide relief because it's not party to the MLC. And then the amount A that is allocated to market jurisdictions is correspondingly reduced with respect to the proportion of relief for this non-participating relieving jurisdiction. And after a transition of 2 years, it is reduced only in case there is no tax treaty between the market, in case there is a tax treaty, sorry, between the market jurisdiction and the relieving jurisdiction. So I now give the floor to Sandra, who will go into tax certainty.
Thank you, Laurent. So we've seen an innovative multilateral basis for allocating taxing rights over part of an M&E's residual profits, and now we're going to see an innovative multilateral framework for tax certainty. Now, depending on the M&E, they may require certainty over different provisions in the MLC at different times, and this is recognized in the design of the framework, which has several different elements. And so we have 3 possible certainty processes. The first one being that an M&E may request scope certainty to get certainty upon the fact whether they are, or more important, are not in scope of the rules. And so by obtaining that certainty, they would remove the risk of separate audit inquiries in several parties identified by the M&E in its request. Once you're out of scope, when you're out of scope because you fall either into the extractives or the regulated financial service exemption, and you have been considered out of scope via the process, then there will be a follow-up process based on simplified documentation that will reduce a lot of burden for the M&E. Next, there's also elements in the MLC where we expect the M&E to develop methodologies and controls to report data in a way that they would not need to do for any other purposes. Particularly, this is the case for revenue sourcing and some of the exemptions which are based on approaches developed for purposes specifically for amount A. And for these elements, we have advanced certainty available that will apply for a certain number of years, removing the need for these areas to be looked at again year after year after year, as long as at least as the critical assumptions continue to apply. And then finally, if you are an M&E in scope, you will also be able to request comprehensive certainty, which means that you would get a single review for a period that leads to binding certainty over all aspects of the MLC that have not been covered by advanced certainty, and that will be binding in all parties to the MLC. Now, all of these 3 routes to certainty are supported by a mandatory binding dispute resolution mechanism, and that is something special. So there is for all of them a determination panel, including a mix of competent authorities and independent experts that will guarantee a multilateral binding certainty for any M&E that submits the requests and cooperates in the review process. Now, if an M&E would not request comprehensive certainty, of course, it will bear the risk of domestic tax examinations in parties where it may have a liability to pay tax on amount A, or where it claims relief for double taxation. Now, when parties would intend to undertake a multilateral tax examination of the M&E in that situation, they must first notify the M&E, and then the M&E would still be given an opportunity to request for comprehensive certainty and obtain a binding outcome from all parties to the MLC through a coordinated process. Of course, that certainty will arrive a lot later than if the certainty would be asked in advance. So we have 3 types of certainty. If we go then to the next slide, you will see that for all of them, they have special features, but they also have a lot of things in common with regard to the process. And for each of them, the requests made by the M&E to the lead tax administration starts the process. And the lead tax administration will typically be the jurisdiction where the ultimate parent of the M&E group is resident. And so the request will be accompanied by a standardized documentation, the documentation depending upon which type of certainty that is requested. You will then be reviewed either by a panel or by the lead tax administration. If it's a panel of different tax administrations. And the rules on whether it will be a panel or the lead tax administration, they are like a balance for the benefits from a periodic review, including a number of tax administrations, or a more streamlined process involving just one single tax administration between these reviews. So we have the two situations that are possible. And as an example, a panel will undertake comprehensive certainty when it is being requested for the first time. And then if there are material changes to where an M&E would pay taxes on amount A or where it claims relief, it will also be done by a panel, or after 5 years, if a panel is proposed by an affected party. If it's not proposed, then the review will continue to be undertaken by the lead tax administration. Now, on the other hand, if we look at advanced certainty, it is expected that in the future it will only need to be requested every 5 years anyway, or if there is a change in an M&E's business or methodology. And so these reviews will probably always be undertaken by the panel. Now, in each case, the panel will include tax administrations from a mix of jurisdictions. So for a comprehensive certainty review panel, it will include the lead tax administration, 3 jurisdictions providing for relief for amount A, and 3 market jurisdictions, which include at least 1 non-OECD, non-G20 developing economy. Now, once a review begins, the approach in the MLC responds to some of the comments that we received in previous consultations, and that ensures that the M&E is involved in the process. So there will be meetings or calls where the M&E can present its approach. And wherever it is likely that the approach will not be agreed or that changes will be recommended, the M&E will have an opportunity to respond to the comments. Also in response to comments from consultations, we have strict time limits on the review, but I will tell a little bit more about that later on. Now, once a review is complete, a summary of the outcomes will be exchanged with relevant parties to the MLC, which are then given the opportunity to either agree or to object to the outcomes. When there's no objections, to save time, there is an opportunity, where there are objections, to save time, there is an opportunity for consultation again with the M&E, where they can ask for additional explanation to see if an objection can be withdrawn. If in the end all objections are withdrawn or there are no objections, then you have a binding outcome for the M&E. If there are still objections, so if there is disagreement, the situations that are in disagreement will be referred to the determination panel for a binding outcome. And then, so what is very important here, and then if we can go to the next slide, is not only that mandatory binding tax certainty is provided, but also that the framework for amount A certainty includes a very special element, and that is strict deadlines for the review. And for each of the review processes, there is a deadline by which the lead tax administration or a member of the review panel must reach a decision. And the first time an M&E requests certainty, these deadlines are increased by 90 days because everything needs to be looked at for the first time, but there's always a clear limit. And very importantly, there are consequences when a decision is not reached within that deadline. So where the review is conducted by a review panel and there is a panel member that cannot reach a decision within the deadline, it will be disregarded so that the panel can reach agreement without that member making a decision. Where the review is conducted by the lead tax administration, and there is an issue where the lead tax administration cannot reach a decision, then it will be assumed that it supports the approach taken by the M&E. Now, you will probably understand that in practice, we expect that the deadlines will be respected and that they will reach decisions rather than face the consequences of not taking a decision on time. But I think it's very important for the taxpayer that there are these consequences if the deadlines are not respected, because that is something very novel in dispute resolution and dispute avoidance. Now, where issues are referred to a determination panel, again, the panel must provide its conclusions within 90 days. Now, the clear limits for review and for the resolution mean that after the first year, if we take comprehensive certainty, from the date the review commences, certainty will be provided in around like 16 months if there is no disagreement, and let's say 27 months if there would be disagreement. For the other certainty processes, the timeframes are even shorter. Now, as long as an M&E cooperates in the review, there are no scenarios possible where certainty for an M&E can be delayed beyond these timelines that are being set in the MLC. And if we compare these timelines with the current situation of having an audit that can run for several years, then followed by dispute resolution, or if you take dispute prevention and the time it takes for dispute prevention, well, then you have like long deadlines, and this cannot happen here. Now, with that, I'll hand it over to Sriram to talk to you about the certainty for issues related to Amount A.
Thank you very much, Sandra, and good morning, afternoon, or evening to all. You just heard about the Amount A tax certainty framework from Sandra. I will now take you through the framework for tax certainty for issues related to Amount A. So as you know, Amount A coexists with the existing international tax rules. And so the MLC contains improved tax certainty processes for disputes under existing tax treaties that could affect Amount A, which we call related issues. So we did hear earlier from Chris that, for example, transfer pricing cases or adjustments or withholding tax adjustments would be made into the elimination tax space. So these cases which would end up having this sort of knock-on effect on Amount A would be given tax certainty through the MLC as well. So what are these improved processes? These improved processes include the mutual agreement procedure, which we call the MAP, which talks about both access and implementation, which I will go through in detail, and a mandatory binding dispute resolution process for issues that are unresolved in MAP. Now, I mentioned related issues. What are related issues? And I think that's an important part of what you would be thinking of when you heard that. The definition covers a broad range of disputes on existing tax treaty rules, specifically transfer pricing cases, cases for attribution of profits to a permanent establishment covered under Article 7, and withholding tax characterization disputes. That is, questions as to whether a transaction should be a withholding tax case or a business profits attribution case under Article 7. So it's not just that the case should fall under these treaty provisions, but the cases also need to have an impact on Amount A based on whether one of two tests is met by the adjustment concerned by the dispute. So first, we would check whether the adjustment would change the relieving jurisdictions or the relief tier of any jurisdiction under the elimination rules. I think Chris went through that in detail. So the idea here would be, would including the full adjustment, which we're talking about in transfer pricing, for example, would including the full adjustment in the jurisdictional profit referred to as the elimination tax base of an M&E with respect to the adjusting jurisdiction in the year of adjustment result in a change in the relieving jurisdictions or the relief tier? So that's the question. If the answer is yes, then the adjustment is considered to have an impact on Amount A. If that test is not met by that adjustment, then the second test involves a materiality threshold. We would check if the aggregate quantum of all adjustments made by a jurisdiction during a year to that M&E amounts to at least euro 1.5 million. Important to note that here we look at the adjustment amount and not the tax amount. So if that test is met as well, each adjustment in that quantum would then be considered to have an impact on Amount A. To note, for an initial 3-year period, the threshold would be euro 3 million instead of 1.5 million. So now moving on to the mechanism itself on the next slide. As mentioned, there would be 2 stages, the map stage and the dispute resolution stage. Step 1 is the map stage, where the MLC includes a new map provision. The primary goal here is to improve on many existing treaty map provisions. That is, to allow the submission of a map request to both competent authorities, which ensures access to map in all cases and ensures the possibility for each of the jurisdictions to move the map case forward. The provision would also allow the implementation of map agreements in all cases. So these are the 2 most important points there. So moving on from the map to the dispute resolution stage, the dispute resolution stage starts with an M&E request if a map case, either under the MLC map provision, which I mentioned in step 1, or a treaty map provision that does not already have mandatory binding dispute resolution. If that map case is unresolved for 2 years, then the taxpayer would submit that dispute resolution request, which starts the dispute resolution stage. Important to note that we have rules to ensure that the 2-year period starts without delays and rules for clear information requests, etc. Now, step 3 has some procedural steps for appointing a panel and giving the required information to the panel. One thing to note here is that each panel would have 5 members comprising the 2 competent authorities, 2 independent experts selected by each competent authority, and an independent expert chair. Important to note again that we have strict default rules to ensure that a panel is always set up. Now, moving on to step 4. Step 4 involves the panel choosing one outcome from among those proposed by each competent authority as a last best offer decision. The panel also has access to the taxpayer's views in the map request to guide this decision. Now, finally, the competent authorities would then see this outcome which the panel arrived at and would enter into a mutual agreement to reflect the chosen outcome in step 5. Something to note here, once the dispute resolution phase starts, the process should be concluded within around 390 days in the streamlined process because of all the procedural efficiencies which I mentioned and which we have achieved through this. An additional thing to point out here is there is a special elective binding dispute resolution mechanism for developing economies that are new to MAP, where they can voluntarily elect to go for binding resolution or not. This applies to low income or middle income economies that are not OECD or G20 members, that have not received negative input from other jurisdictions on how they conduct MAP, and that have no or low levels of MAP cases. So what does no or low levels of MAP cases here mean? It means that the 3-year average of the number of transfer pricing or permanent establishment attribution MAP cases in a jurisdiction's MAP statistics should be less than 10 cases. Note here that, of course, this is a proxy for jurisdictions that are new to MAP, as I mentioned. So once any of these conditions are met, a jurisdiction would not be eligible for the elective process going forward. So once they develop experience in MAP, they move from the elective to the mandatory binding process. So in sum, this enhanced tax certainty process for related issues would ensure that, first, tax administrations are encouraged to focus on dispute prevention to avoid the resource outlay. So they would focus on risk assessment, APAs, or other such processes. Where disputes arise despite these efforts, the framework allows them to be handled in the most efficient, effective, and timely manner. Like I said, we have several procedural features that address issues noted by taxpayers in existing procedures. And most importantly, I think the procedure would also allow in-scope M&Es to leverage this process to seek to resolve some of the testy transfer pricing or business profit treaty disputes that they have, including issues that have been unresolved in MAP over the years for each successive year. And with that, the tax certainty section of this webinar is concluded. I will now pass to Jesse, who will talk to you about the coverage of DSTs and relevant similar measures. Thank you.
And thanks very much. So with respect to the removal and standstill of DSTs and relevant similar measures, you'll see an overview of what the MLC does. It provides for the removal of certain existing measures. It provides a definition, a forward-looking definition of DSTs and relevant similar measures. It provides for a review process for new measures to make sure that they're evaluated and that a result is received. It addresses the treatment of subnational measures imposed by subnational jurisdictions of parties, and it deals with certain other types of measures that are within the scope of tax treaties and that otherwise don't meet the definition of DSTs or relevant similar measures. So with respect to the removal of existing measures, the MLC includes a legal commitment to remove the measures that are listed in Annex A with respect to all companies. We had a question from the audience, so why all companies and not just in scope companies? Well, part of the purpose of the MLC is to arrive at a coordinated global solution that avoids double taxation, that provides increased certainty to taxpayers. And as part of that, it was important to address the uncoordinated application of DSTs and relevant similar measures. Having both systems out there applying at the same time would significantly undermine the goal of the MLC. And just to respond to one of the other questions we got, that's also why the negotiating governments have chosen not to contemplate reservations in the MLC text, because variations in the way that the parties apply the system would undermine its ability to achieve its purpose of avoiding multiple taxation and providing certainty. I guess the other thing to cover with respect to the existing measures is that they are a list of measures. They're not meant to imply one way or the other whether the measure would meet the definition of DST or relevant similar measure. But looking at that definition on the next slide, for measures other than the listed measures, there's a definition that uses 3 cumulative criteria. Is the tax applied by reference to market-based criteria like the location of customers or users, which is typical of DSTs, but not typical of traditional income taxes? Is it ring-fenced to non-resident or foreign-owned businesses, either de jure, meaning by its terms it can legally apply only to non-residents or foreign-owned businesses, or de facto, meaning it has scope restrictions that have the effect of causing the measure to apply exclusively or almost exclusively to residents or foreign-owned businesses in a way that effectively insulates domestic businesses from the tax. And is it treated by the party that imposes the tax as outside the scope of its tax treaties? There are specific exclusions for some types of measures. These are mostly clarifying exclusions because many of the measures wouldn't meet this definition anyway, but there are exclusions for consumption taxes like VAT. There are exclusions for certain types of transaction taxes, and there are exclusions for rules that address artificial avoidance of sort of traditional physical presence-based permanent establishments. Measures that are enacted can be reviewed by the conference of the party on the request of either the party contemplating enacting it or by a party who believes it violates these or meets the definition of DST or relevant similar measure. And if a measure is determined through that process to be a DST or relevant similar measure, then the party that enacts it is denied its amount A allocation. Slide 47 sets out how that review process works. The details here are provided for your information, and the slides are going to be available after the webcast. But the main things to take away here are that the evaluation of measures is designed to take no more than 12 total months, and that at the end of that process, there will be an answer about whether the measure is going to be considered to be a DST or relevant similar measure. And by default, amount A will be denied if it is found to be a DST. It'll be denied retroactive to the first period in which the DST was enforced, subject to a 3-year limitation. So if measures are only brought up years after they've been operating, then you only reach back 3 years. There is the possibility for prospective application only under limited circumstances, though. With respect to subnational measures, turning to slide 48, what happens if a subnational jurisdiction of a party enacts a DST? Well, here the MLC had to confront the fact that in some federal system, parties may not be able, whether legally or politically, to actually forbid their subnational jurisdictions from enacting measures. So where a subnational jurisdiction enacts one, there won't be a denial of amount A, but there will be a review process that is identical to the one that applies to measures enacted directly by parties. And the parties then have to demonstrate that they're doing their best. They're exercising their best efforts in good faith to get those measures removed. finally, there's a special rule, and you'll see it on slide 49, for measures like significant economic presence rules that have non-traditional nexus requirements that don't rely on physical presence, but that don't meet the definition of DST or relevant similar measure because they're placed within the scope of the enacting parties' tax treaties. And the intent of those provisions is generally to tax a portion of the profits of an M&E based on a non-physical nexus focused on market-based criteria, and that overlaps significantly with the purpose of Amount A. So while imposing these measures doesn't cause a country to lose its Amount A allocation because they are not DSTs, they are different than DSTs, they will be required to turn off these measures as applied to group entities of the in-scope M&Es. So the measures can't apply concurrently with Amount A. They have to be turned off for countries that sign up to the MLC. And with that, I think we've reached the end of the program. We've tried our best along the way to answer the questions we've received as they've come in. Apologies for any we didn't get to answer live. Thanks very much for bearing with us as we also ran over about 20 minutes. Have a great day.
Yes, thank you very much for everyone who attended. And just to flag that any and all MLC material are available on the OECD website, and you can contact us by email, or you're more than welcome to follow us on social media should you wish. Just a gentle reminder, please note that the webinar was recorded. The replay will be currently processing and we will upload it within 24 hours. All registered participants will be notified by email when the replay and the presentation slides are available. And with that, have a lovely morning, afternoon, evening, and we hope to see you again soon for another webinar. Thank you very much.